In Chapter 22, we learned how to make a master budget before the period starts for planning purposes. In this chapter, we will learn how to use budget information at the end of the period to assess the firm's performance. Remember, the master budget is made before the new period ever starts. That means that it's based on an expected level of activity and the expected cost per unit multiplied by that level of activity. At the end of the new period, the master budget becomes what's called a static budget. It gets that name because it was prepared at a specific level of activity. That is, the activity level that was expected before the period started. But what if the actual activity level is different from the expected level? That wouldn't make a very fair basis for comparison. Let's see what happens. The laboratory at Eastgate Hospital performs various kinds of lab tests for patients who come to the hospital. It has 4 cost categories: the salaries of lab technicians, the benefits that those technicians receive, the supplies that are used to perform the tests, and training that the technicians might need in order to perform the tests. Before the period started, the laboratory at Eastgate Hospital prepared a budget based on its expected level of activity, and this became part of the master budget. Now that the period is over, those numbers become the static budget, the expectation for how much it would cost before the period began. Here are the actual costs for each cost category and the total for running the laboratory during this period. If we compare the static budget to actual costs, we get what's called a static budget variance, the difference between the static budget and the actual costs. And we can try to use that information to determine whether the laboratory at Eastgate Hospital is over budget. The difference between the static budget amount and the actual costs for salaries is $30,000. But we don't use positive and negative numbers in budgeting. That would only cause problems. Instead, we mark this difference with a U for unfavorable. In other words, the cost for salaries was greater than what the static budget predicted. When costs are greater, they are unfavorable. We can do the same thing for benefits. It actually cost the laboratory $5,000 more than was predicted in the static budget, and we mark that as unfavorable. It cost more than expected. Supplies actually cost $11,000 more than the static budget amount, so that's also unfavorable. And training cost the laboratory $4,000 more than the static budget amount, so that is unfavorable as well. Altogether, when we compare actual costs to static budget amounts, the laboratory is $50,000 over budget. And we can confirm that by comparing the static budget total to the actual cost total, $50,000 unfavorable. And the hospital director is furious. He wants to know what's wrong with the laboratory at Eastgate Hospital because it seems not to be able to stay within budget guidelines. Is the lab over budget? It certainly looks that way because the actual costs were greater than the amount predicted in the static budget. But is that a correct analysis? Remember that the static budget is prepared before the period starts at the expected level of activity. Once the period's over, we can prepare a flexible budget at the actual level of activity. If we want to, we could also prepare a flexible budget at any other activity level. For example, if we wanted to do some sensitivity analysis. So can the static budget be used to evaluate performance? And the answer is right there. If it happens that the static budget is prepared at exactly the level that occurred during the period, then the static budget is the flexible budget at the actual level of activity. But that doesn't happen very often, and if it does, it's really sort of a coincidence. But if the actual activity level is different from the static budget level, then you cannot use the static budget to evaluate performance. It wouldn't be a fair comparison. Let's see how that works. Let's look at some additional data about laboratory services at Eastgate Hospital. Before the period started, the hospital estimated how much they thought it would cost per test for salaries, benefits, supplies, and training. In addition, they estimated that the lab would provide 13,000 tests, although the actual number of tests performed was 14,800. Let's incorporate that into our analysis. Here is the cost per test that we saw on the previous slide, and the numbers that we saw in the static budget came from these costs. For example, the salaries for the static budget represent $30 per test times the 13,000 tests that the hospital expected the lab to make. And the cost for benefits is $5 per test times the 13,000 tests that the hospital thought the lab would make. Similarly, the supplies cost was estimated at $3 per test times the 13,000 tests, and training was $2 per test times the 13,000 tests. In other words, the numbers in the static budget came from somewhere. They came from an expectation of how much it would cost per test times the expected 13,000 tests that the hospital estimated the lab would do during the period. That means that we can compute a flexible budget at the actual level of activity, 14,800 tests, in the same way by multiplying the cost per test times the flexible budget amount, the actual level of activity. So we multiply $30 of salaries per test times the actual number of tests. We multiply $5 of benefits times the actual number of tests, and $3 of supplies per test times the actual number of tests, and $2 of training times the actual number of tests. And we can add those up to find the total flexible budget amount, that is, how much would the hospital expect the laboratory to spend, given the fact that now, at the end of the period, we know for a fact that the lab did 14,800 tests. Now we can compare the flexible budget at the actual activity level to actual results, and that will give us what's called a flexible budget variance. For salaries, we see that the actual cost was $24,000 less than the amount predicted by the flexible budget. So we mark that as favorable, that is, less than the budgeted amount. By the way, note that favorable and unfavorable don't necessarily mean good or bad. They represent whether costs are higher or lower than expected. Similarly, we see that the actual cost for benefits was $4,000 less than the amount predicted on the flexible budget, and we mark that favorable. When it comes to supplies, we find that the actual cost was $5,600 greater than the flexible budget amount, so we mark that unfavorable. And for training, the actual results were $400 greater than the flexible budget amount, and we mark that unfavorable. Now we need to determine the total flexible budget variance, but some of these variances are favorable and others are unfavorable. The easiest way to do this is to add all of the favorable budget variances together and then add all of the unfavorable budget variances together, subtract the smaller amount from the larger amount, and the answer gets the sign of the larger amount. In other words, a total of $28,000 favorable variances minus $6,000 of unfavorable variances gives us a total of $22,000 favorable flexible budget variance. And we can check that result by comparing the total flexible budget at the actual level of activity to the actual results. Based on this analysis, we can see that the laboratory at Eastgate Hospital is not over budget. In fact, it's under budget by $22,000 when we compare the actual results to a flexible budget prepared at the actual level of activity. So a flexible budget variance is the difference between the flexible budget at the actual level of activity and the actual results. And this will always be a fair comparison for evaluation purposes because both the flexible budget and reality are at the same level of activity. A different comparison can be made by finding the difference between the static budget prepared at the expected activity level before the period starts to the flexible budget prepared at the actual activity level after the period is over. We can see here that the flexible budget total is much higher than the static budget total. That makes sense since the firm actually did a lot more tests during the period than the hospital had estimated before the period started. This difference is called a sales volume variance. Both columns show budgeted amounts. The only difference between them is the number of tests expected to be done versus the number of tests actually done. So the difference in the costs is only attributable to that difference in the number of tests. But what about comparing the static budget to actual results? Remember, the static budget was made at 13,000 tests, the amount that they thought they were likely to do, whereas reality happened for 14,800 tests. Nothing good can come of this comparison because the budget and actual results were at different levels of activity. So, the moral of the story is that the static budget is very useful for planning. Before the period starts, we don't know how many tests the laboratory is actually going to do, so we make our best guess. But for evaluation, for control, for determining how efficient and effective the laboratory was, you have to recompute a flexible budget at the actual level of activity.